and tight labor markets and so on are really the same. So I think, I don't think there's been a major change in the underlying process that generates inflation, only a series of shocks related to the pandemic that gave us this episode. Going forward, I agree with Jay that we can't predict, what new shocks will come. We've got new technologies out there that might, make big changes in our economy. We've got, green investment, things like that might affect the price and availability of fossil fuels. And so there are many, many things that we can't predict. But I think that broadly speaking that the inflation process has not changed. And it's one aspect of that, which is very good news, is that the Federal Reserve's credibility has helped keep inflation expectations, particularly longer-term inflation expectations, reasonably well anchored, which is always sort of the first step in getting control of inflation.
You mentioned the role of the labor market tightness in the inflation process. I think it's quite striking that right on the eve of the pandemic, the unemployment rate was around 3.5%, a 5-decade low. Yet at the same time, inflation was kind of struggling to get up to 2% on a sustained basis. Here we are in 2023. The unemployment rate is roughly at the same level as it was prior to the pandemic. But of course, inflation is far above 2%. So in that context, should we be thinking about the relationship between slack in the labor market and inflation differently? Do we not have the right measures of slack? Is it the problems with understanding what the natural rate of unemployment is? Or is slack really not the key to understanding inflation in the first place? Dan, you want to take that one first?
As I was talking about before, I think that the pandemic, to some extent, scrambled the usual signals from the labor market. And the Federal Reserve over time has begun to put more weight on things like the vacancy to unemployment ratio, which seems to give a better signal in a period of change when the labor market matching process is in change than the unemployment rate. So there has been some scrambling of those signals. That being said, it's simply not true that, even in people who've understood since the 70s that there's not a simple inverse relationship between inflation and unemployment. In particular, what can break that relationship is supply shocks. And so during the 70s, we didn't particularly have tight labor markets most of the time. We had high inflation, because we had oil price shocks, which the Fed did not respond to adequately, B, because inflation expectations were not well anchored, and there was a strong tendency for price increases to feed into wage increases, to feed into price increases. So because of the presence of supply shocks and inflation expectations dynamics, there's no reason why low unemployment and high inflation can't coexist, but the remedies might be, depending on the situation, might be somewhat different.
Jay, how are you thinking about that?
So I'm very much in agreement with that. It's certainly true that we had both before and after the pandemic unemployment very low, close to 3.5%, but that we only had high inflation after the pandemic. Does that mean that our understanding of the relationship between slack and inflation is badly wrong, or that it has changed fundamentally after the pandemic? And my answer would be tentatively no to both of those questions. I think what really is different this time was the series of unexpected and persistent supply shocks that featured in the inflation process. I don't think labor market slack was a particularly important feature of inflation when it first spiked in spring of 2021. By contrast, I do think that labor market slack is likely to be an increasingly important factor in inflation going forward. In particular, inflation in non-housing services is showing signs of real persistence. In this highly diverse sector, labor costs are a high proportion of total costs, and that sector happens to account for more than half of the core PCE index. But all of this, the point is, all of this can be explained, I think, using our standard framework for understanding labor market slack. You could say it this way, that the natural rate of employment probably rose sharply as the pandemic severely disrupted the labor market. And the implication of that would be that an unemployment rate of, say, 4% indicated a much tighter labor market in 2021 than it did in 2018. And as Ben mentioned, of course, after the pandemic, we began looking at much more closely at alternative measures, particularly vacancies, but also quits, which have been signaling even greater tightness than the unemployment rate alone might have thought to have been signaled. I mean, to put some numbers on it, we at the end of 2018 and the end of 2021, we had 4% roughly unemployment in both cases. In 2018, the vacancies to unemployment ratio was 1-to-1 essentially. In 2021, it was 2-to-1. And that was a much better indicator, obviously, at that time of the simple standalone unemployment rate. Although, as I mentioned, you could also think of it as the natural rate being highly elevated. The other thing is, it may also be the case that the Phillips curve has steepened, meaning that inflation has returned, at least for now, to be more responsive to changes in the labor market.
Old school Harvard na lang.
You know, the Phillips curve was once thought to be fairly steep after flattening. Relationships in the economy, like the Phillips curve, evolve over time, so I would not characterize that as a problem for our understanding of inflation.
Very good, thank you. Maybe we can pivot here to the topic of central bank communications. It's widely understood now that the better the public understands the conduct of monetary policy, the more effective it will be. But fostering that type of understanding really requires a lot of communications, and of course that can be hard. Both of you have been powerful advocates for advancing monetary policy communications, both with an eye toward making policy more effective, but also for the purposes of promoting transparency and accountability. Ben, you've obviously played a critical role here, advancing the FOMC's communications, including the introduction of press conferences after FOMC meetings, the introduction of the summary of economic projections. So what changes over this period since the communication, say, revolution began, would you highlight as being some of the most effective, most important, and where do some remaining challenges exist?
Well, let me talk about communication, because I think you need to understand that it serves multiple purposes. I mean, one of its purposes, the narrow purpose, is to try to align market expectations with the Fed's own thinking. I think that goes back to Alan Greenspan. You go back to 1994, the first FOMC statement. I mean, since then, the Fed has tried at least to give some indication of what it's thinking and what it sees as the risks to the economy. But beyond that, you mentioned transparency and accountability. This is a powerful institution. It's very important that it be accountable to the Congress and to the public, and the best way to do that is explain what we think, what we're doing, and how we're going to go about that. There's other reasons for communication. One I would talk about is feedback. We're having a conference here. If the Fed puts out the issues that it's concerned about, economists will write articles or tweets and respond to that. Or in the case of the Fed Listens program, maybe it would be more ordinary people who are explaining, how monetary policy affects them. One final thing I would mention is diversity of views. Because the Fed has a consensus culture, and there are very few dissents normally, the outside perception is the Fed is subject to groupthink, which of course is possible, but with people talking about, their own views and explaining why they see the economy as they do, it does, I think, at least to some extent, show that there is a range of opinion on the committee. In terms of tools, I guess I do feel proud about the press conferences, which I introduced 4 times a year after the summary of economic projections, in which Chair Powell has taken to an art form. I think also, just the inflation target, the forecasts that we release, and there's a cultural change, which some people don't like, but I think on net is good, which is, it used to be, if you look back at speeches in the Greenspan era, the president of the Federal Reserve Bank of Minneapolis, would talk about, harvests or something, wouldn't talk very much about the global or national economy. Now you have a lot of people talking about, the different aspects of the Federal Reserve's views. And again, that contributes to both market transparency and also to accountability to the local constituency and to the national constituency.
Jay, you, of course, have continued to push forward on the communications and transparency fronts. Welcome your thoughts.
You know, I think the broader setting is that transparency is especially important today. Polling data show that many important public and private institutions globally have struggled to retain the public's trust and support in recent years. Now, we're an institution that serves a critical public mission, but to be here and work here is to know that the particulars of what we do and how we do it are not generally top of mind for most people. And on top of that, we have a critical and a rare grant of independence. And all of that, to me, means that we have a special obligation to explain ourselves clearly, what we do, why we do it, to provide transparency to the public and their elected representatives in Congress so that we can earn and deserve their trust and support. And that's a critical task if we are going to sustain our democratic legitimacy through this interesting period. My colleagues and I really take that as a primary and affirmative, proactive obligation and not something we see as a burden or of second-order importance. So in that spirit, to your point, we have followed the example of Chairman Greenspan beginning in 1994 with the first post-meeting statement, through Ben's innovations and Janet as well, in looking to foster greater transparency and accountability. And a couple of examples, we now do a press conference after every meeting, not just every other one. We have greatly expanded our congressional outreach to be certain that we hear directly from lawmakers on an ongoing basis, so that they have the information that they need to conduct appropriate oversight. As I mentioned, in 2019 and 20, we conducted a public review of our monetary policy framework, seeking input from a broad range of people and groups all around the country. We've also significantly expanded transparency beyond monetary policy. For example, we now publish semi-annual financial stability and supervision and regulation reports. Of course, there are always communication challenges, especially I find about communicating the uncertainty that attends our assessments of economic conditions and the outlook. And a good example of this is, despite our persistent efforts to explain otherwise, the policy paths from the SEP seem regularly to be taken as a firm plan or a committee decision, rather than what they are, which is a compilation of individual participants' best assessments on a particular day of appropriate policy under the assumption that conditions evolve in line with their baseline forecasts. So that's just a challenge that we constantly face in the context of great uncertainty. Despite that, I would say, though, that the summary of economic projections has actually been very useful during this tightening cycle, as markets have looked ahead and priced in future rate hikes, long before they're actually implemented.
Your last point really brings up the idea of communications as being an effective policy tool. And I guess the key element of that is the use of forward guidance. Jay, in one school of thought, forward guidance is a tool that should really only be deployed when interest rates are at the effective lower bound. And so you can no longer provide accommodation by lowering rates further, and so you do so through communicating about the policy path in the future. But another school of thought, forward guidance should be just a regular part of communicating with the public to convey the committee's policy intentions, even far away from the effective lower bound. Where do you come out in that debate?
Well, I do think it depends on circumstances. I do think that forward guidance can be useful when policymakers have a materially different or clearer view of the likely path of policy than does the interested public. I would agree at the effective lower bound when we need to provide more stimulus by indicating an intent to keep policy accommodated longer than the public expects. There's a use case there. I also would say, though, that communication comes with a cost of misinterpretation, and it also may limit flexibility. So I think we should use forward guidance sparingly when the course of policy is either reasonably well understood or, on the contrary, is so dependent on uncertain future developments that little really can be said constructively about the future. And a good example of that was the March 2020 FOMC meeting. The pandemic shutdowns were just beginning. The level of certainty was almost unimaginable, and we chose not to issue an SEP at that point. Really, our view was that releasing a forecast at that time might have been more of an obstacle to clear communication than a help. In contrast, as I mentioned a minute ago, forward guidance has really been a useful and effective tool during the current tightening cycle, as financial conditions have tightened well in advance of actual rate increases. The 2-year tightened between the September 21 meeting and liftoff in March of 20, it tightened by 200 basis points before we ever actually lifted rates, and that's significantly because of our communication. So in the current context, until recently, it's been relatively clear that further policy firming would be warranted, and our forward guidance has said so. Now, however, we've come a long way in policy tightening, and the stance of policy is restrictive, and we face uncertainty about the lagged effects of our tightening so far and about the extent of credit tightening from recent banking stresses. So today, our guidance is limited to identifying the factors we'll be monitoring as we assess the extent to which additional policy firming may be appropriate to return inflation to 2% over time. As I noted at the last press conference, that assessment will be an ongoing one as we move ahead, meeting by meeting. Having come this far, we can afford to look at the data and the evolving outlook and make careful assessments.
Thank you. Jay, you mentioned that guidance can be useful at times when the public may expect a very different policy path than policymakers. How do you think about those sorts of situations?
You're right. So recently it has sometimes been the case that markets appear to be pricing in a different rate path than the committee expects will be appropriate. But I would say that disconnect does not seem to reflect a misunderstanding of our reaction function or a lack of belief that we'll do what's necessary to bring inflation down. Rather, it appears to reflect simply a different forecast, one in which inflation comes down much more quickly than the committee participants think.
Ibig sabihin lang nun, guys, wala na naniniwala sa kanila.
I would say
Kaya
also, so
tinatanong
far
yung
the
tanong
data have continued to support
Magkaiba yung
the
market
that
versus
bringing
them.
inflation down will take some time. Moreover, something we often don't remember to think about is that market prices always reflect both expectations and compensation for risk. And what market participants say in surveys of their expectations is actually closer to the views in the SEP than what is reflected in market pricing. So ultimately, my colleagues and I have our forecasts and market participants have theirs. Our role is not to advocate for our forecast. What we can do is be clear about our expectations for growth, unemployment, and inflation, and the likely implications
Kasi the market
for
take things
policy.
with a grain of salt.
As well, we want the public to understand how policy would react if the path of the economy were to differ materially from our expectations. And of course, we do lay out our individual forecasts quarterly.
Ben, what would your takeaways be for the past couple of decades' use of forward guidance as a policy tool?
Well, Charlie Evans and co-authors have made a useful distinction between what they call Odyssean and Delphic forward guidance. Odyssean forward guidance is a commitment forward guidance, which is rarely used, but typically at the lower bound, where the central bank promises to do something, and its credibility on the line that it will follow a certain path going forward, and that's a way of getting more stimulus. And I think, again, that goes back, again, to Alan Greenspan, I think, to indicate that a certain path was very likely, and that actually helps achieve the objectives. Delphic forward guidance is basically just a forecast. Here's what we think. Tomorrow we might think something different, but we're just trying to, as part of our transparency, we're just trying to give you a sense of where the economy is going and how we think policy will react. Now, as Jay points out, there are some problems in practice. One is people don't understand the difference all the time between a commitment and a forecast. That's something that Jay has emphasized, and I think should be emphasized. Another is people underestimate the amount of uncertainty involved, which is enormous. So I don't think you can do without some form of forward guidance, because the idea of transparency says, here's what we see, and here's why we're thinking. And so the idea that there's no guidance at all, most of the time, I take March 2020 as a counterexample, but most of the time you do want to give at least a sense of where you think the economy and accordingly policy are heading. I think, just if I might editorialize one more minute, I think one of the issues is that the FOMC is so large and geographically dispersed that it's been difficult to come up with a collective committee forecast. We tried to do that when I was chair. The dot plot is a compromise, which is not ideal. Other central banks do other things. Sometimes they have collective committee forecasts that are voted on, or they use market rates, or they publish the staff forecast. So there are different ways to go about this. But again, I think that forward guidance is both an instrumental tool, but again, letting people know sort of how the central bank sees the evolving situation even if there's lots of uncertainty, which you can say normally is part of transparency.
So you highlighted uncertainty as being a key factor in dealing with some of these issues. Obviously, uncertainty is a pervasive feature of monetary policy making, and often invokes, the so-called risk management approach to making monetary policy. Maybe we can start, Jay, with you on this topic. The FOMC's raised the federal funds rate by 5 percentage points in a little more than a year. That's a very rapid pace by historical standards, as we all know. How do you view those actions in the context of the uncertainties that you and the committee faced about the economic outlook, and how did risk management considerations factor into your decisions?
So I'll start by remembering that Alan Greenspan famously said that pervasive uncertainty was the defining characteristic of the policy landscape. It's worth remembering that he made that comment during what we now think of as the Great Moderation. So that statement has never been more apt than it is today. If you look back, the pandemic, the global shutdown, the historically forceful response and the reopening, all of that had no modern precedent. So it has been a time of historically elevated uncertainty and of unexpected outcomes. No advanced economy had ever faced a shutdown and a reopening, and now all of them would face it at the same time. So no matter what happened, the outcome was going to be unprecedented. So this level of uncertainty posed real challenges for policy and policy communications. On the one hand, we had to be nimble to be able to respond to the evolving situation. On the other hand, we wanted to be as clear as possible about what we were doing, lest we add to uncertainty. So I would say policy certainly has been nimble, consistent with what were then our expectations. The data did actually show declining inflation through September of 2021, but then turned decisively against that expectations thereafter. And in response, we accelerated our policy firming, ultimately, as you noted, raising rates by 500 basis points in just over a year.
After nung November na sinabi niyong transitory, hoy, sabihin mo yun.
The object was to reach a stance of policy that is sufficiently restrictive to return inflation to 2% over time.
Tigilan mo ako, Powell.
But we also
September, hello,
communicated that the
lumuktaw ka
level
ng
of rates that
November
would ultimately
2021, puro kay
required was highly
transitory.
uncertain. Now, until very recently, it's been clear that further policy firming would be required. As policy has become more restricted, the risks of doing too much versus doing too little are becoming more balanced, and our policy has adjusted to reflect that fact. So we haven't made any decisions about the extent to which additional policy firming will be appropriate, but given how far we've come, as I noted, we can afford to look at the data and the evolving outlook and make careful assessments.
So sobrang play safe niya ka, Miranda, puro sa data-driven. Look at data.
Sort of the academic literature on
Yeah, I moved from that side to this side.
Yeah. How does it work in practice?
I say uncertainty when you're an academic is trying to decide whether your error term is Gaussian or not. In actual policy making, you don't even know what the current quarter GDP is, because it's going to get revised, several times down the road. I remember when I was sitting just as a member of the board, and Greenspan was in the chair, and we had responded to some inflation data, and a little bit later, it turned out that inflation change had been revised away. And I asked the chair, do you think we can revise our interest rate policy? It is very difficult. I mean, got to laugh with that, but, just trying to make policy, it involves not just uncertainty about, the data, about the model, about all the things that can happen, about the social and economic and political environment. So it's very difficult. And unfortunately, or fortunately, given that monetary policy works with a lag, given that there are risks on both sides of the modal forecast, there's not much choice but just to accept that uncertainty and try and, do the best you can, being ready to adjust as new information arrives.
Very good. Thank you. We are getting close to the end of our allotted time. Maybe we could wrap up with just a question looking ahead. Jay, maybe we can start with you. What would you point to as some of the key issues that will be most relevant to the research community as well as to the policymaking community?
So I guess I would start with the labor market, and what we talked about earlier of vacancies in particular, and the beverage curve, and the whole discussion over whether the extraordinarily high level of surplus demand in the labor market can be lessened through the vacancies channel without a significant increase in unemployment. That would be more akin to what has happened in all prior cycles or most prior cycles. So that's going to be a question that we will resolve empirically. But I think we're learning new things about the workings of the labor market, at least in this one situation. I think on monetary policy, it's going to be interesting to look back and try to understand how inflation spread from what was very, at the beginning, very focused on the goods sector due to the rotation of demand from services to goods and the tremendous amount of support that goods purchases got from fiscal and monetary stimulus. How did it spread then through really into the service sector where it now significantly resides? I think we're seeing much progress on goods and we have progress in the pipeline on housing services, but where we see persistent inflation is now in the service sector. So what is the mechanism by which that happens and what are the implications?
Ben, you have the last word.
Well, I think one of the things that I would urge researchers to look at is the relationship between monetary policy and financial stability. A very, very difficult relationship. If you read the papers, you see that everybody has a very strong opinion about this subject, but they don't necessarily correlate. As Mark Twain once said, the things you don't know can hurt you as much as the things that you know for sure, but ain't so. I think that we really do not understand to the extent that we need to the relationship between different aspects of monetary policy, risk-taking, balance sheet behavior, et cetera. It's just something, there's a lot of good work being done, don't get me wrong, but I think we need to understand much better what the channels are and to quantify the relationships so that we can think about to what extent we need to take that into account in monetary policy.
Very good. Well, let me thank both of you tremendously for sharing your perspectives with us today. It's been a highlight of our conference honoring Thomas Lobach, and so thank you very much. Round of applause. That wraps up the morning portion of our conference. We're now going to take a lunch break, and we will resume our program here at 1 p.m. Thanks, everyone.
Ayun, grabe yung market, no? Sobrang grabe, napaka-volatile. Like what we have really reminded and said, no? So sana lahat tayo kumalma, no? Talagang the market will be just running crazy, Miranda. So, couple of things na gusto kong i-discuss sa inyo, Miranda, will be couple of highlights na sinulat natin. Although late na akong nag-live, Powell naman was actually, hindi naman tayo medyo talagang sobrang na late in terms of our live, Miranda. So, couple of things na, give me a second, no? Give me a second. Okay. Give me a second. Yeah, so one of the things na nakita ko dun sa sinabi ni Powell, sabi niya in-acknowledge nila ito medyo gumanda yung paningin ng market nung sinabi niya to kaya medyo umangat yung market kanina, no. Sinabi niya na he understood the harm done by high rates of inflation. No, sinabi niya 'yon, no? He understood the rates. Let me just try to get my notes here. Okay. So sinabi niya na, let me just try to open. So he said that the harm done by the high rates of inflation and pledged na yung policymakers would not be going, would not be really focusing that much on over tightening. So medyo gumanda yung paningin ng market dahil doon. Sinabi niya, while the financial stability tools help calm down the conditions in the banking sector, developments there on the other hand are contributing to tighter credit conditions and are likely to weigh on economic growth. So ibig sabihin nun, nagkaroon siya ng recognition na talagang because of your monetary tools, no, talagang naapektuhan yung banking sector. Nung inacknowledge niya na meron nang epekto yung monetary changes, doon nagkaroon ng paglipad kanina, pero eventually nagkaroon ng pagbaba. No, when he was now asked about labor market, sinabi niya nga si Phillips curve, no? Yung Phillips curve kasi, ito yung sa mga nag-take ng economics 101 dyan or 201 nung college kayo, yung Phillips curve, isa itong phenomena or isa itong curve na sinasabi na inflation is inversely and stably correlated. So kumbaga sa liwa, habang tumataas si inflation, unemployment should be going down. Pag tumataas si unemployment, inflation should be going down. Okay? Yun yung sinasabi niyang Phillips curve. Ang sinasabi ko lang doon, sino ba ang gumagamit ng Phillips curve ngayon? Mga taga-school na lang. Yung mga real market economists, it's just a textbook reference. Maghanap kayo ng economics professor if they're still using it. Sasabihin nila, ginagamit nila for textbook. But for monetary application, siguro wala na siyang mapagkumparahan. No? So, basically, when unemployment numbers are going higher, which tumataas naman yung unemployment, sabi ko kanina sa live natin, highest in the past decade, gumaganda si inflation. Diba? Bakit? Kasi nga, demand destruction. Pag walang trabaho ang mga tao, wala silang pangbili. Pag wala silang pangbili, hihina ang demand. Pag hihina ang demand, bababa ang price ng mga goods. Diba? So, yan. So, finocus din niya yung surplus demand through vacancy chance. Sabi niya sana doon na lang kumuha yung mga naghahanap ng trabaho, no? Wag na silang kumuha pa sa current labor market, no? Doon na lang sa mga, I don't know what he meant by vacancy channel, but yun sinabi niya. And then he was focusing, I think they're focusing too much on controlling labor numbers na. Kasi nga tingin nila CPI numbers mga baba na. Since January pa ha, bababa na yon CPI numbers, di ba, from 7.1, 6.7, 6%, 5.5 ngayon, 4.9 na lang and 5.5. So talagang pababa na talaga siya. That's a good sign. Pero ang sinasabi niya, teka lang, yung employment numbers, kailangan hindi maiwan. Kaya makikita mo, marinig mo sa kanya, halos pa karaniwan, puro employment labor numbers yung sinasabi niya kay Miranda. So sa akin lang, in my own perspective, medyo play safe siya eh. In fact, sabi niya kanina, data-driven. Tingin ko natuto siya doon. Kasi nung January, February, nung nag-declare siya ng victory, di ba, he was using the word disinflation. Nagdiwang yung market. Tumaas yung cryptocurrency, tumaas si Nasdaq, tumaas, di ba? Pero nung nagkaroon ulit ng pangit na numbers and labor numbers were very hot nung March. Nag-iba na naman siya ng tono nag-iba na naman, 'di ba? So ngayon, I think for the month of May, talagang 2 years na siya natuto sa lesson niya. Ang medyo kung hindi kayo nakikinig talaga sa kanya, ang hindi niyo na pick up diyan when he was talking about history in the discussion. Meron siyang talagang forcefully kinaligtaan niya, and that is yung pagkakamali nila noong November of 2021. Siya yung humaharabas ng transitory to, di ba? I was even listening to them, and I was even telling every one of you, transitory nga talaga siguro. Wag tayong, di ba? But they were wrong and everyone else was wrong. Kaya maraming naluging kumpanya noong 2022 kasi nga yung forecast nila for November inflation going to 2022 was all incorrect. di ba nga sinasabi kasi ni, di ba, November 2. So, ibig sabihin, sinasabi lang niya na, September, nagsisimula na daw kami magkaroon ng tighter monetary. Lumipad siya ng 2022. Hello, 2021, ikaw nga nagsabi sa amin na transitory. Ba't hindi mo sinabi? Syempre, why would he shoot himself to the foot? Di ba? So, nagkataon lang, matagal ko na siyang pinapanood, kaya alam ko na yung mga nagsasabi niya. So I think for me, talaga nakita mo up, down yung market. Simply because I think the market is overreacting on this particular market. No? So, ang sasabi ko sa iyo, Miranda, pag meron mga FA news, lalo na if this guy is talking, kalma ka lang. Kumalma ka, wag kang aligaga. No? I mean, do not declare victory yet. No? The market can always just, go up, down, Miranda. And that's your edge as an FA trader, di ba? Kumalma ka, hayaan mo where the market is going to lead you when the market already confirms a trend. Pag may FA ka, Miranda, be very, very mindful. Mag-iingat po tayo in all of the things na meron po tayong ginagawa from a trading perspective. Alright? So, again, kumalma. That's the word of the night. Kalma. Kumalma tayo. Huwag tayong aligaga. Kahit meron kang TA, mawawalan ng kwenta yan because you have an FA. Trust me. Yan po ang topic ko tomorrow sa ating Shangri-La discussion. The macroeconomic drivers of Bitcoin. The macroeconomic signals that you can use that can help drive price action of cryptocurrency. So sana meron ka nakuha today. Yun ang pinaka-quick summary natin. Kung yun, may own opinion ha. Ngayon, maraming lalabas na mga marurunong dyan. I-consume nyo din yung information nila. Pero for me, I think it's a very play safe interview. There's not much monetary discussions that was given. They remain data driven. But again, no, I think for the most part, mag-aantay talaga tayo ng June 14 to know if we're going to pause or not. Okay? You're going to pause or not, Miranda. Alright, so I hope that nakatulong sa inyo yan, no? At give me a second, Miranda. Ano? So, teka lang. Phillips. Ito, isa pang sabihin ko din, sinabi niya dito kasi na there was a persistent supply shocks that featured in the inflation process. I don't think the labor market slack was a particularly important feature of inflation when it's the first spring of 2021. By contrast, the labor market slack is likely been increasingly. So, meron siyang pinpoint about supply shock, no? Hindi ko nahihimayin dito, pero siguro at mga months ago sinabi ko yung glut, no? Kasi nung nagkaroon tayo ng isa sa mga dapat na-recognize din nila nung nagkaroon tayo ng pandemic, maraming tao nag-stock ng pagkain, ng tissue, kung ano-ano eh. So ang daming supply. Ang daming supply na nakapalibot sa market. Anyways, I'll discuss that on the latter part of the siguro tomorrow. But again, tomorrow, kinig kayo sa akin, I hope that you're learning it na mapadali ko yung inyong interpretation of the market. Marami nang gumagaling sa inyo dahil sa FA. Pero sana habang gumagaling, wag na uubos ang pera. Kumalma kayo, Miranda. Alright? I love you 3,000, Miranda. And I will see you tomorrow po in our Shangri-La event. God bless you and I love you 3,000. Bye!